the SMEs, subject matter experts, at any time for entrepreneurs is awesome. So being able to bring everybody together to ask questions, go into breakout rooms, and really kind of pick the brains of our partners is great. And then also as a heads up, to put teeth into the idea around like the SAPs being an extension of our membership, the SAPs have actually are in a forum now. They've all been forum trained, and the forum's actually going to be starting next week, 2 weeks.
Next Friday, I think it is.
Yeah, awesome. And so just as like a, in a weird year where it's tough to build relationships, trying to find ways for our chapter to bring value to our SAPs, getting them into a forum experience and getting forum trained, seemingly will work out. I've heard some stories of this going really well and it going really poorly. So we'll see how it goes, but I'm pretty sure with our group, we're going to be in for a treat. And so today we got Meridian, RLB, and then we got, Warren, and then we're going to go into Mike. We're going to have a break, get into Zach Sutherland, and then go into breakout sessions. So the breakout sessions are essentially going to work. So like if there's a topic that comes up that you just want to like learn more about or ask questions about, you can kind of just chat Trisha. And then we're going to like kind of rapid assign folks at the end. So you can kind of hit up a breakout room based on the topic of the SAP. I'm not sure if there's anything else right now in terms of introing what we're doing today. We've got an event coming up in March. Well, I guess our next one's February 10th with Dr. Jess, the relationship expert. Mitch has organized that, so I think that's going to be awesome. And the ski day's been pushed to March 5th. See if that actually happens. And then I think what's the next one with the Oculus event is March.
Yeah, we haven't really touched on that or started marketing it yet.
So yeah, cool. So
to it.
Yeah, okay, awesome. So just as a heads up, we're buying Oculus VR goggles for everybody that's part of the chapter. And we're going to be doing a virtual reality event on a rooftop where we can have snowball fights, play cornhole, and there's a basketball. But we're having scaling up coaches come join. So we've got Daniel Marcos, who's the CEO of the Growth Institute. We got Herb Cogliano, who's like one of the kind of like best scaling up coaches in the ecosystem. Going to be joining us, and I'm working on a special guest as well. So that'll be a really cool event. And then we'll all have VR goggles to play around with. So I don't know. We're going to try to get them out to you in a couple days before, so you can kind of get used to what it's like. I've never used one before, but it looks like it's going to be a ton of fun. There was a chapter out of EO North LA that tried this out with this company out of the Netherlands, and they said it was awesome. So that's kind of where the idea was inspired from. And it'll also give us an opportunity to do some cool stuff instead of just being in Zoom environments all the time. So yeah, enough of me. Why don't we introduce? We got Meridian. So we've got a couple of folks, right? And so I'm not too sure how you want to format this, but maybe Karen, I'll let you do the introductions, and I'll just put myself on mute.
Is Karen back? I can start off.
Oh, go ahead, Adi.
Okay, I can start off, Rob, and thanks for inviting us over today. I know Karen's been working very closely with you guys, and I've been I kept in constant touch. So it's a fantastic partnership that we have. Lots of cool stuff happening, lots of opportunities for learning and sharing. So it's been a great partnership for us. Thanks for inviting us again. We had a few ideas that we threw around in terms of what we want to cover, and by some back and forth, we decided on something called the Cool program, which we've just launched, thinking that there might be some of the people attending today who might be interested in getting maybe a commercial mortgage and a high ratio commercial mortgage, for that matter. Before I get Rob to get started on that, I'll just take a minute to Rob Edwards. I'll take a minute to just talk about Meridian, who we are, what we do. So if you don't know, we are the second largest credit union in Canada, book size of about $22 billion, about 2,000 employees, Ontario based. We have close to 100 branches in Ontario. What I take care of is that I am the RVP for the Guelph Business Banking Center. This is a team of about 25 or the commercial bankers and small business bankers, primarily focused on lending as well as deposits from businesses. Our loan size or relationship size can start right from a few $100,000 right up to $125 million for the large corporate clients as well. So that's what we do, primarily focused on commercial real estate in the area, as most credit unions are looking to diversify. Got franchise financing coming in, lots of other interesting stuff. We are, new programs we are launching for professionals, pharmacies and other franchisees as well. But not to get into all that, there's a lot of things to kind of talk about, but the idea was to kind of focus on owner-occupied commercial real estate today and talk about that. So what we've done is a quick short presentation for you guys. And I think we'll open it up for questions more in the breakout session. I will introduce Rob Edwards quickly. He is the manager small business. He manages a team of senior small business associates and small business advisors across this area. So that business is usually from 200,000 right up to 2 to 10, depending on the program. He manages a fairly large book of business in the small business world in Guelph, very experienced. So off to you, Rob, and take it away.
Thank you very much, Adi. Very experienced, maybe, but the cool program is very new, so no experience in this yet. So I'm glad to roll it up to this team.
Rob, sorry.
I feel like I know you, and I would like.
Rob, your voice is breaking up.
You broke up really bad there, Rob. You were fine speaking earlier. I'm not sure what happened there. If you go off of your camera, it might work a little bit better, but if you want to come off mute, we can check.
Technical difficulties.
Okay, I shut my camera off. Can you hear me a little bit better now?
Yes, it's better. A little bit scratchy, but I'll let you know if it stays consistent.
Okay, did you hear anything I said in my introduction?
Not quite, no. If you want to start over, that'd probably be best.
It's still pretty rough though. Like, yeah, I'm not sure if there's maybe a restart or something like that, and maybe we can go into a different topic. But give her a shot, and if we're a minute in and it's still really tough to hear, we might just put a pause.
Sure.
Okay, very good. Yeah, just please let me know. So we just launched this cool program, which is a commercial owner-occupied lending. And what it's meant to do is to free up cash for the business owners who don't want to sink a lot of their money into down payments for the properties that they're going to be occupying. It's to provide the real estate financing and day-to-day banking for operating entities that exhibit strong cash flow and debt serviceability. So it's a higher end product, and it's not meant for startups or people with poor cash flow, but more meant for people who can sustain the payments. One thing that's very important about it is that it does have to be occupied by the operating company. It can't just be a holdco, although the holdco can own it as long as the opco is operating it. Normally in commercial real estate lending, we like to go up to about 60% loan to value, but the COOL program allows us to go up to 100% financing. And it's just a more streamlined and less onerous process than some of the other programs that are out there for like leverage financing, whereas we take an equity position in the operations, which we don't want to do, and it is a lot more onerous, like I said. This can be divided between a term loan and an operating line of credit. So you can go up to 100%, and for example, say you do 75% as a term loan. And then you can do the rest as an operating loan, like a line of credit. Can we go to the next screen?
Yeah, I switched it over for you.
Okay, thank you. No, I seem to be having a little bit of difficulties here with my video. Okay, so what is a cool transaction then? It is with the operating entity, the OpCo, the operating company, occupies a minimum of 75% of the gross square footage of the building pledged as security. So you're the operating company and you're occupying the building that we're financing up to 75%, a minimum of 75%. And you also, the operating company has to account for 75% of the gross revenue from that asset. So what we do as security, we could do a first mortgage and a first GSA, or we can do it as a first GSA and a second mortgage, or a second GSA and a second mortgage. As we go along those routes, though, it gets a little bit riskier, and the rates and the terms may change, and it may dictate that we don't go 100% in certain circumstances. Can we go next one, Trish? Thank you. So examples of people who may want to take advantage of this program. And these are just examples. And I was looking over the list of the people who are on the invite list, and it seems that most people would fall under this this program. So example, manufacturers, distribution companies, retail outlets, professional companies, doctors, anybody who occupies their own building. Some of the things that are ineligible, we don't do startups. Like I said, we like to have established companies who can demonstrate good cash flow and the ability to repay. And we don't do things like cannabis or anything that's sort of avant-garde that we haven't got our minds around yet. We don't do construction financing or transactions that we have specific programs for. So who would qualify? So established operating businesses with a minimum of 3-year strong financial history. The debt service ratio, which is the ability to repay the debt, must be equal to 1.25 times or greater for loan to values up to 85%, and would require a higher debt service ratio, which means it must be stronger for loans to value up to 100%. Other than that, it's regular Meridian lending requirements. There's really not a lot of difference between the underwriting for this program and for any of our other credit facilities. We go next, Tricia. So just, I won't go through this step by step, but these are just examples of things that we would ask you for, and not just for this program, but for any other kind of credit application that you're doing. And it basically, what it is allows us to look at the company to see the cash flow, the owners, the guarantors, to see how strong the application would be. Depending on the particular security, the type of business it is, there may be other things that we ask for. So again, these are just general things, but these are usually asked for in just about every application. Rates and fees. So I know this is something that everybody would be interested in knowing about, is how much is it going to cost you. It's not too different from our regular programs. The higher you go in the line, the loan to value, there may be a premium on the rates and the fees just because it becomes a riskier loan. But generally it's at between prime plus 1.5 to 3 for variable rate loans. And for the fixed rate loans, currently anywhere between the high 3s and the high 5s, depending on the risk rating factor. If there's second mortgages and second GSA, we would add about 1 to 2%, just because our security is so much less. We have to factor in the risk rating. And application fees and arrangement fees, somewhere between 75 and 100 basis points. And there would be an annual review of this, and the fee for that would be based on the complexity. So again, we can go up to 100%, but we would reserve the right to drop the parameters a little bit, depending on the state of the security. If it's a sort of rundown building, we might not go to a full 100%. We might only go up to 65, 75%. Same as, you know, it depends on a lot of factors. So please do keep in mind that we can go up to 100% and not will go up to 100%, depending on the different factors. Same with the amortization period. We will go up to 25 years amortization, but if there's an economic lifespan of less than 25 years, we would drop that down to match it to the economic life left on the asset. So I know we didn't have much time, and I hope that did come through clear. I want to stress that this is just one new program that we have, and I log a particular product, but we have a whole list of various credits, cash management, accounts, anything that you would need for your day-to-day banking. And I know I didn't go into this too much in depth, and we were kind of rushed a little bit because of the technical difficulties, but I will be happy to answer some questions in the breakout session.
Sweet, thanks, Rob. Is there one or two questions out of the gate though that anybody might want to ask? I just had a quick one around if there's two opcos that own a holdco and they're going to both occupy the building, would that qualify?
I'm going to say yes. That's never come up before, but I'm going to say yes. Addie, you sound like you have some insight into this.
Yeah, for sure. Rob, the answer would be yes, if it's the same ownership group.
Great. Yeah, okay, sweet. We'll be talking. Karen, you got to be here in 3 years.
Real quick one, just in your experience, buildings on 2 to 10 million, what's kind of the overall percentage you can estimate for closing costs and, you know, all those fees?
So if you look at only commercial mortgages, so we're not talking about a GSA from the operating company, maybe just, you know, personal guarantees, which are pretty standard attached with it. It should be fairly simple. We are going to get the mortgage registered, the documents done up by the lawyers. I would say, and really each case is different, so don't quote me on that, but I would say $2,000 to $5,000.
Sweet.
I would also add that that's the bank closing costs, not necessarily your appraisal fees and maybe environmental assessment, your legal fees and whatnot. But just from our end, I agree with Addie.
Yeah, so the number I quoted was for only the lawyer's fee. I didn't include our arrangement fee or any of the environmental fees and all that in there.
Yeah, I'm more looking just total cost percentage. Is it 2% of the value, or is it's just kind of totally depends? I mean, obviously environmentals can get.
It really depends. The bigger you go, Dennis, the lower the percentage, right? If you have a $10 million building, right? So percentage wise, it will be lower. So there's no real thumb of rule like that. If you have an appraisal, you know, that's not too old, let's say it's a year and a half old, we could probably end up using it. If you have an environmental, which is not too old, you know, same rule applies. So you know, it's kind of different in different situations.
Okay, thanks.
Sweet. Awesome. Yeah. So I think Zach's up. Actually, what's the value like for commercial properties right now? Are they sticking or are they going down?
They're going up.
Ah,
yeah.
Good news.
Industrial commercial is hot.
How much available in our area?
Yeah, exactly.
It might be a little bit different in the big cities and all that with office space and whatnot. There's still a jury's out on that one, but it is busy out there. I'm surprised about how busy we are right now.
Sweet. Okay, awesome. I think thank you so much for that, and we'll get you in the breakouts. So if anybody wants to get into commercial real estate more, and then I think Mr. Zach, you're up next, bud.
Beauty. How's everybody doing today? The most exciting topic of the day, insurance. Who doesn't love learning about insurance? Let's go. Love every second of it. Let me just get the presentation up here. Give me a second.
Should put a caveat at the accountants at the end, so we may have a debate there, Zach.
Okay, that's entirely fair. I'm glad I'm going first, so that'll keep it easy. Let me just get, you guys see this presentation okay? We're good there?
Yeah, we can hear you and see you really well, Zach. Thanks.
Perfect. Sounds good. So I wanted to take today, because insurance itself, getting into the product and that side of it, we're far too general in what everyone does here. So I wanted to talk a little bit more about what you can and what you should be having conversations with your advisor about when you do get to the review of your policy, or even potentially after this, pick up the phone and make the call now. There are things that can be done in our space because it really is a challenging one at the moment. While the world is in a global pandemic, the insurance industry decided to increase everybody's rates because we're sweethearts. It's an interesting time, and I'm going to dive a little bit into how and why the market got there for your knowledge base, which will then tie into, with that knowledge, here's what you should be doing with it. Here's the questions you should be asking. Here's the topics you should be focusing on and preparing to put your best foot forward and get the best possible rate you can in this new and very challenging market we're in at the moment. So just to go over that quickly again, how do we get here? The market, why all the questions? And that's something I'll touch on in a little more detail. And then how do I win? I think that's the most important thing I want to get out of this today. And if you're going to listen at all, listen to that slide, because that's the one that's going to go over the questions you should be focusing on for your business right now. So let's talk about insurance companies and the wonderful myth out there that, they take all my premiums and what do they ever pay back to me? How do they make money? So insurance companies, again, this is a very quick crash course because I don't want to go through it, but to make it very simple, they make money off the interest rate of the money they hold, which is heavily regulated by the government. It's basically just T-bills. And their combined operating ratio, which is how much money they take in versus how much money they pay back and pay their staff and salaries, et cetera. So if we go back past 5 years, 14 to 19, of the top, 10 companies in Canada, the average combined operating ratio, which is that profit percentage, was 99%, which means for every dollar they pull in, they made a cent. And you all know what the interest rates are. So they made 2 cents, basically, for every dollar they brought in, which is, again, an average, but points to a disturbing trend in the industry as we've seen interest rates trend down over time. So you couple that with insurance interest, and rightfully so, in big data. And this is the other caveat that's really pushing and directly impacting every individual in this room. But we've gone from a place where when I started 12 years ago, I could walk into a business, write 5 things on a napkin and get you a price, to if I don't have about 100 questions answered, I'm not even going to get a quote. It's a drastically different world we've entered, and I'll touch more on that in a second. So what that also created, which is a true joy, is the segmentation of risks. Where as a broker, as an advisor, I used to be able to say, okay, we talked about commercial real estate just before this. That's a great example of something that's incredibly difficult to insure right now. And the reason being is I'll give you a very easy example to relate to. I have the largest insurance company in Canada, Intact Insurance. For commercial realty, your building must be built within 3 to 25 years of today's date. That means if you built a brand new building, they won't touch you. If it's over 25 years, they won't touch you. If you're in your 25th year, next year, they'll kick you out. That is the way the world's changing. From we used to write whatever kind of fit within that tranche to now we have enough data that says we only want to take the risk tolerance for things that fit very, very specific criteria. If I were to dive deeper into that, which is an entirely other conversation, I could tell you all the risk factors they're looking for in commercial realty, but that's one glaring one that we look at as our industry, and you see it dive deeper and deeper as you go. It's a scary, scary thing that doesn't get talked about enough, and very important for you to understand when you're going into these equations. And the pandemic. So where have we all been during the pandemic? Sitting on our chairs at home. Where haven't we been? In the office, at the commercial property, wherever we might be. I apologize. I don't know why it's come through. But anyways, we haven't been where we haven't been at the office. So what has that resulted in? Your home losses, your personal property. If the water starts going in the basement, you're home. You get that 6 inches of water out there, you get somebody called in half an hour. Your business, you haven't been there in 2 weeks. That water hits, it sits there, it keeps going up and up and up. And by the time somebody gets there to see it, that $50,000 loss is now $1 million. And we've seen that consistent in results this year. So when you tie those losses into tranches of where the risk goes, it ends up hitting commercial property or business property. which is where a ton of your rate is coming from right now. So they are experiencing worse loss ratio in business insurance right now than they did the year before, even though you would think potentially the opposite, but it's just not the case at the moment. So why so many questions? And I bring this up because in my renewal reviews with our clients, we are asking things we've never asked before. And it's a lot of pushback we're getting because they're saying, you know, you insured me for 40 years. Why was this important now? And the simple answer of it just is never enough. To be very clear, it's the way underwriting's now changed. So these insurance companies used all this data they collected to create basically a computer system that they input all of these points into that says, here's my company profile, address, this, that, the other thing, the 100 questions they have, and it spits back out a number, no matter what industry you're in. And they say, you can write this for this premium, this is what we want. And then there's some fluctuation, an underwriter, who's the person who's at the company who's assessing your risk, will spit back a number for, which is great. So when this used to be done by a human, they generally give you the benefit of the doubt. If it's done by a machine, if the machine doesn't see a data point, it assumes you're the absolute worst in that category. It doesn't give you the benefit of the doubt. And therefore, I need to ask, and we need to ask these advisors hundreds of more questions that we never asked before, depending on your segment and risk, and clarify our data from maybe a few years back, just to be sure. So it's creating a larger process, which can be very frustrating to the client, but trying to give you that perspective as to why we're doing it. Because giving something is generally, it wasn't necessarily better than nothing. It certainly is now. And that's a big part of it. So the best rating is going to the person with the most information most of the time. And that's a huge part of it. So it's really important for your advisor, and your advisor will know case-to-case basis what's important to your specific business and what's going to paint your business in the best possible picture. That's their job. Your job is to provide it. And it's going to be a bigger ask than it ever was before if they're putting their best foot forward for you. So how do I win? How do you in your business, when you're reviewing with your agent, your advisor, whomever that may be, what should you be focusing on right now? The very first thing I can say is confirm the data points. Because there are, for every industry, everything you do, there are 3 or 4, maybe 5 data points that weigh a little bit different. And don't expect them to know that right away, because I'm telling you right now, those data points are changing monthly, weekly in some cases, depending on the industry, depending on the segment. We can make the call and go get the information, right? But it may not be as easy as a quick answer. But that's something you should be digging into. What can I do to change it? Can I actually affect those things? And the biggest one this year we've found, the one that makes a real difference, especially during this COVID year, is revenue. So revenue is usually your liability rating factor. And what that means is that you pay a certain percentage of your premium to liability. It's usually affected by the size of your revenues. Okay. So if that's the case, if your revenues went to almost nothing, but you reported 200,000 last year, there's a chance you can get a credit or potentially reduce your premium going forward this year just by exposing that and having that conversation. Incredibly important data point. So I highly recommend going through those current revenue for this year and projections with your advisor, because there should be a way, or could be a way, that there's going to be actually significant impact to savings. Now, in caveat to that, of course, there's things called minimum premiums, which often kick in. There's a lot of reasons why this may not work for you, but it is a worthwhile conversation. I think another one that's being missed a lot in our space is this concept of being best in class. And as an advisor, I know more about insurance than you do, but I do not know more about marketing. I don't know more about the bank. I don't know more about anything it is that you do. That's your world. And this is where it's important, because I, as the advisor, am the one selling you now to the insurance companies. So if I don't understand why you're better than your competitor, they're going to rate you in your algorithm the exact same. And that's not what we want. We want to give them every possible reason why, for whatever it is, whether it's a manufacturing process that you do that's just slightly different, but more safe because it's been proven here, here, and here, This is going to make a real difference now, because within that rating algorithm, they have tiers in some of their systems that say, what are your, let's say, risk management practices? And it'll be a kind of 0, good, great, excellent, whatever that scale may be. But if there's no information, guess what it is? It's 0. And therefore, you've accomplished the worst rate you could get in that category, right? So these are the little things that have changed. Those things weren't really important before, but they are now. And we have to do a job as an advisor to sell your company. I tell all my clients, you're now the Taj Mahal of whatever you do. Tell me why. Let's find out. Let's go. That's what I need to get you the best possible rate. And this is another one that kind of ties into it, but I think it's really important because it's, again, being ignored. Offer up what you do for risk management practices, whether you have a risk guide, whether you have, you had an incident that occurred and then you changed. And then because of that, it changed the way you operate. Those little tidbits of knowledge allow us to do our jobs in terms of selling you to our company, saying these people care. They care about risk. Because I think one of the biggest points I've taken out of how insurance used to work in terms of even 2 years ago versus how it works now, that's the scariest, is you used to see a risk and say, I haven't had a claim in 20 years. That's great. And insurance used to rate that low. Now data says you're due. It's a different world. They look at it as a number. So how do I mitigate that number? Each and every one of your businesses will have approximately 0.5 claims in their business cycle. 0.5. How do I make that 0.5 lower? Risk management practices, being the best at what you do, focusing on those data points that can reduce that number. And that's an individual conversation on every basis, but getting to that conversation is what I encourage each and every one of you to do. And within that, I am happy to have a more individual conversation with all of you about what I'd be looking at for your particular industry, if that's of any help. And you can certainly reach out to me, Sutherland Insurance. And I think most of you know me or have my contact information as is, but certainly happy to share it. So with that, we can hop into quick questions, but otherwise I'm good to go.
Sweet. Thank you, sir. I got a couple, I'm not sure they're in the chat, but maybe just want to kick us off. You talk about the idea of like risk management practices. And so typically when I look at risk management, I'm thinking health and safety and cash. Mm-hmm. So like what specific examples can you share with us in terms of what risk management would look like?
100%. I actually did my CRM, so certified risk management as well. So we offered that service of going into the business at times just to do a quick analysis. We have three of them in our office. But really, it's as simple as, and this, it sounds crazy, but we have a fire escape above our door. We have lights that direct everybody to that. Not every building has that because that's not by law. It really is identifying these small things that you do that make you special. And it's digging into, that's an easy example of the fire escape signs. But anytime, and this is where we're learning in this new market as well, what's important to insurers, because I'm telling you, it does change all the time. But I sold an insurer on a policy recently based on the client explaining to me how they had a loss 2 years ago that they didn't put through insurance, but here is the list of changes they made to make sure it never happens again. So I would encourage it being more experiential of, hey, we heard of a company that did this, so we made these slight alterations to either our practices and procedures or our written down risk plan. And it doesn't have to be that, health and safety, here's our health and safety manual and this, those are great. But it almost is better if you can tie it to an experience and really pointing that back to what we've changed to make sure this particular risk does not occur again.
Yeah, that's cool, man. We have like rope ladders because we're on the second and third floor. I just don't know how safe they are. I've never actually tried one. I think I'd actually probably bail if I did it, but we have them just in case.
Hey, and that's a small detail, but will make a difference in terms of the liability in the fire.
That's cool.
They consider it. Yeah.
Zach, would risk management also be in like manufacturing on how to ensure you don't have an environmental spill, how you have maybe a fire safety plan, sprinkler system, 3 or 4 people trained on, using fire hoses, You've got at least one safety person per shift. All those kind of things in a complicated business would show that somebody's on top of their risk management.
1000%. And I think just taking it from that, the idea of the generalization of the different businesses we have here, but as well, if we're focusing on that manufacturing situation, what you'd want to show is what you're doing and then compare it to what the industry either expects or other people in your industry are doing. And getting back to that best in class, well, it is a requirement to have one safety person on for this shift for this amount of time. We have 4. Easy and extreme example, but you get what I'm saying. So, and that's where that tie back I get to of you're the expert on your business, I'm the expert on mine. You tell me what the standard is. But if I don't know what the standard is, I can't argue it in your favor. And that's really the piece from the risk management side. It can be, manufacturing is a great example because there's tons of requirements for health and safety guides and their procedural documentation that you can go through, and it's great. But thinking about it from, I'll just use Rob and your marketing firm. You don't have any of that, right? But there is still ways to show that you are doing more than everybody else.
And so from like a whole numbers perspective, what can someone expect if they were to take it to the nth degree and really dig in and provide all the information? What kind of cost savings would someone expect?
I've seen cost savings this year in the double-digit percentages, just to keep it rough, after doing a full review and generating everything back. Again, I've seen it make no difference at all, just to be entirely honest with you.
Yeah, no, that's cool, man. Thanks.
It's entirely case specific, but I have seen it be into the significant percentage of double digits, which was fantastic.
So how old's the Sutherland building?
That was built in, originally in the 70s.
So it will Intact, your insurance underwriter, not write insurance for your building now?
Correct.
That's crazy.
Yeah. Yeah, correct. That's what their data point says. So technically they would take it if they had it before, but they are knocking those off as they come now. That's when I say things change monthly, that 3 to 25 year window was announced about 6 months ago. That was a change they made. They go, we still love commercial realty, but check. And if it doesn't, we're out. So we're starting to see the drop off of those things. And when they come to renewal time, you would say, okay, 25-year client potentially, always been with Intact, this. Yeah, no, doesn't fit in our data points. See ya. It's
awesome. Why don't we as consumers demand renewal guarantees over 10 years where we don't go with those insurers?
Yeah, you know what? 5 years ago, you could have got it. It was an open market where people were doing anything. It was a conversation about, what are you paying? I'll cut 10 points. Let's have a day. It was a negotiation. It really was. Now it's not. And it ties back to that they're not making money. They're not making money they need to make underwriting profit because there's no interest revenue anymore. It's next to nil. So they have to make operating profit. And they believe that big data at the moment is the way to do it. And arguing around that from it's kind of the recent media GameStop example. If the hedge funds own the clearinghouses, they're probably going to stop them from screwing them. And in the case of insurance, the insurers are going to say, you can try and ask for that, but I got data that says you're wrong and I can't. And if nobody else is willing to offer it, because there's technically 200 insurers in Canada, there's 10 of them that control the market. If none of the other 10 are going to do it, they don't step on each other. So the consumer side of it, though, and the government side is really interesting. Just to speak to it quickly on 2 segments in particular: snow removal and restaurants. Restaurants right now are getting absolutely slammed in insurance at a time where they're suffering almost, I know a lot of our industries are suffering, but in terms of the walk-in restaurant, they're getting crushed during COVID. And we're actually advising our clients, if they decide to shut down, to maintain their policy, because we can't rewrite it right now for any less than sometimes 5 to 6 times what they're currently paying.
Jesus.
What a joke.
It's insane. And it's a really tied in. I think what's going to happen with that is you're going to see snow removal taken over by the government or forced written. And I think restaurants aren't far behind. I really do. Because it is something that's going to cripple the reopening of restaurants as COVID goes forward. It's certainly something we're keeping a very close eye on. Insurance used to be, it was certainly a line item for everybody in their business, don't get me wrong, but one that for 20 years ticked along at around, if you didn't have a claim, 2 to 5% a year, tick, tick, tick. That's not a big difference. Now could be 20, it could be 30, because send out a couple 200% increases this year.
Crazy.
Did everything we could, but right.
All right.
But if we do the data, we can get 10% off that 200% increase.
10% off that. It can help. It can help because it is a line item, no doubt.
All right, we're gonna keep this rolling. Thanks, Zach. I mean, it is really cool to help us understand like the kind of holistic nature of what's going on with the industry and then how it kind of impacts us individually. So thanks. We got Warren Coughlin. You're up, my friend. So do you want to give her?
I will give her.
Sweet.
You can see that all right?
Yep, we can hear and see you well.
All right. G'day, everybody. I'm talking about HIP culture, which stands for high performance culture. And I'm going to argue it is a major key to your business freedom. Now, if you've heard me talk before about strategy, you've heard me talk about 3 buckets, the drive, value, or valuation. On top of that, there are 3 keys to make your business to be optimally saleable. And it can be sold without these, but these are 3 conditions that if they exist, make your business more saleable or just give you more freedom. And they're having a second tier of management, so everything isn't reliant on you. Having a performance dashboard that allows you to manage the business from afar, that you can actually see the key things that are improving or not improving. And then third is having a high performance culture. And if those 3 things exist, the person who's going to come in and buy your business is going to have a business that's way easier to run, which makes it more saleable and in fact more valuable. I'm only going to talk about the third one today, which is high performance culture. Now, this is actually a fairly big topic, so I've taken some essential pieces to try to drill it down to just 15 minutes. If you've heard the statement before, culture eats strategy, I have a little bit of a different take on that. You've heard me talk about strategy before as a big driver of success. I actually believe that strategy and culture together make for a really beautiful marriage. Strategy guides where the culture takes you, and culture ensures that the strategy gets successfully executed. So both are needed and they really leverage each other. And I'll just tell you one quick story. I'll try not to swear, just because this is a quote from a client. A client of mine, they were a partnership. There was a man and woman that ran this business, and it was about $45 million at the time. And I introduced the idea of a values-based culture into the organization, and she was super keen on it. And he looked at me and he went, "This is effing bullcrap," right? Just straight up. And so we didn't do it right away, but she worked on them for a while. A year later, we did it. We introduced us, went through a whole values exercise, then turned those values into behaviors, and then introduced it into the organization. They're now $75 million. They've been named best place to work in their category 5 years running. And that guy who called it effing bullcrap in presentations now says culture, it's everything. It totally transformed their organization. And they work 2 days a week as CEOs, co-CEOs of the business. So it's super transformative. Now, so what is it? So culture often gets, bandied around and people use really fluffy terms around it. If you know me, I like to get things a little bit more concrete. So culture is the behaviors, the incentives, the systems, and the signals that reveal the values of the organization. Now that's super important, right? Because when people do value stuff and they stick it on walls, those are nice statements, but do they actually reflect what's going on? So if you say that you value safety above all else, but a project manager gets bonused for pushing people to higher production targets during wet, snowy conditions, well, you're saying productivity is in fact valued more than safety. If you say that collaboration and innovation are values, but your systems are really tight and prescriptive, well, your systems are saying you value compliance and consistency over innovation. If you say we value support and teamwork, but you bonus the account manager who brings in the most money, even though he treats everyone terribly, you're saying you value money more than anything else, right? So those are systems, those are signals, those are incentives that are, and there's behaviors that are being rewarded or tolerated that are showing what in fact you truly value. You know, on an individual level, I always say, you know, character is revealed, not expressed. That's the same thing at an organizational level. Culture is character at an organizational level, right? You can say what your values are, but you'll show them through what you do. And here's just a great example. These look like wonderful values, right? Who wouldn't want to work for a business that has these 4 values? Take a guess whose values these were. Enron, right? So, and they were actually carved into the stone of the building for Enron. So, you know, you can do a whole bunch of nice work with consultants like me to come in and identify it, but if you're not living it, it just doesn't matter. And here's another reason why it matters. And this will be a little bit counterintuitive to people who are real systems focused, but this is what happens to a business sort of over its evolution. So at the beginning, you've got, so on the bottom axis here is growth, on the left side is complexity of the business, and the right, I call it percentage of rock stars. So when you start a business, complexity is really low, and usually it's you and, you know, maybe a buddy or two that you really trust. So your percentage of rock stars is really high, right? But then you grow and complexity increases. You get really busy, so you can't spend tons of your time on managing and recruiting and that kind of thing. And most people who say, oh, I'm really good at hiring, what they really are is good at hiring people who are like them. But as things get more complex, you need to hire people who are not like you. And forgive me, but my experience has been 98% of the time, people suck at hiring people who are not like them. And so the result of that is your percentage of rock stars starts to decline. And so then you wind up with this gap in here, which is where mistakes and chaos happen. And then what occurs, and this is where it gets really interesting for the entrepreneur, they go in one of 3 directions. Some say, screw it, this is getting too hard, I'm just going to stay where I am, I'm happy, this is good enough. Some people actually shrink. They say, you know what, this was way more fun when it was just a couple of us. This is just too big a pain in the butt now. And then others hire people like me to come in and say, well, systemize your business. Now, here's the problem with that. The rock stars, they don't love systems, right? They tend to remove autonomy, creativity, proactivity, collaboration, and that kind of thing. So they leave, which means your systems then have to get tighter. Now, that's fine as long as things are running smoothly. But as soon as there's a change or a shock, a change in the economy, a global pandemic, new technology, new regulations, new competitor, you no longer have that super passionate, super talented team to help you adjust, right? Because your percentage of rock stars drops. So you get to decide which path you want to take to company growth, one based only on systems or one that's driven by a high performance culture supported by just enough systems to help them unleash their talents, right? And their passions on your behalf. I tend to incline towards the latter. You can over systemize people. You want to have enough systems that there's predictability and replicability, but you also want to give people the ability to shine. And this is, I show the same chart when I'm talking about strategy as in culture. It just shows you where it sits. So there's an alignment that has to happen between the different components of, you'll hear things like vision, passion, purpose, all that kind of stuff. Purpose, vision, those kinds of things. And they have to line up a certain way and they have certain meanings. So at the very base is your purpose, why you exist and do what you do. After that, then there's the impacts. If you want to have an impact-driven business, that purpose, ideally, I've just added this recently in the work I've done because it's become very interesting now, that when you start to articulate how are you going to live that purpose through the impacts you're going to have apart from profits. So that's the specific changes you're going to create to contribute to that purpose, either in your community, in your people, in your customers. Your vision then is to have those impacts, and to fulfill that purpose, our business will have to look like this. The mission is how we choose to create those impacts in pursuit of our purpose. Your values then are how we behave on our journey. That's the culture. That's how we behave on the journey. Strategy then is how we deploy resources to fulfill the mission. And those values act as a guardrail or a constraint around your strategy. If strategies are inconsistent with your values, that's an inappropriate strategy. So that it acts as some guardrails. And then the action, of course, is how you implement the strategy. So all this stuff needs to line up really tightly. And so when you get to values, sometimes what people do is they articulate their values based on their personal values, like the way they like to live at home. They shouldn't be inconsistent with that, but you've got to look at your values through the lens of what are the values that are going to take us to our purpose, to allow us to generate those impacts and to help us build the business that we want to build. That's the lens through which you look at the values. So here's sort of a step-by-step how we go about this. So the first thing you have to do is choose your values. And as I say, these aren't just your highest personal values. They're the ones that are going to take you to your vision. That will allow you to live that purpose, which means if you haven't articulated those things, the purpose, mission, vision stuff, it's going to be hard for you to articulate your values, because what are they in service of? So really, either as part of this work or before this work, you should do that. Now, I over the years, you'll talk to consultants who it'll take them 2-3 months to do this. I had a friend who was doing some branding work, and he developed an algorithm, and he actually patented a process. And I actually played with his process, and I created something that I've been doing this now for 10 years, and it has never not worked, where I've done purpose, mission, vision, values reduced to behaviors in a single 3-hour session. And it's always worked. But you need, however you do it though, you got to make sure all those pieces line up. Get your purpose, get your vision, get your mission, then get your values articulated. And then once you've got them articulated, you have to then describe them in terms of behaviors. If you don't, then you wind up in Enron world where they're just words on stone. Now you'll see sometimes when people do their values that they'll give like dictionary definitions of a value or fluffy kind of feel-good statements like, we believe in doing what's right, or we know there's no I in team, you know, barf, right? There's no accountability in those kinds of statements. So you got to describe them in terms of behaviors. And I prefer first person statements. Like, let's say there's a value of knowledge development. You describe that as, I pursue ongoing education through courses and programs by reflecting on the lessons from successes and failures, and by asking for assistance from my colleagues when I'm not sure what to do next. You can see specifically whether someone is living that value or not, right? Because there's behaviors attached to it. You then need to, once you've described them as behaviors, you then need to talk about it all the freaking time. When you have team meetings, it should be the first agenda item. If you put it after everything else, then you're signaling it's not that important. If you say we're a culture, values-driven organization, then you got to lead with that. And you say, where have we been on value? Where have we been off value? If something great happens, don't just go, yay, yay, attaboy, attagirl. Say, what values did that success reflect? Where did we live those values that allowed that to happen? If something goes wrong, instead of giving somebody hell and, you know, singling them out, say collectively, where did we go off value? And that one becomes really interesting, because sometimes it'll you know, shift slightly to a blame, but then you'll pull out, hey, we've got this value of team, right? So all of you saw that person not living the value of knowledge. Where were we calling them out on that and making sure that they actually pursued that? So we collectively failed in the value of team. And this is where, you know, sometimes when people start this stuff, they make it really kumbaya and sweet and nice. When you take this seriously, this stuff becomes badass. You have like really, really interesting, hard conversations about how we behave as a group. And when you do that, your accountability goes way up. And you'll have some people who will leave the organization because they can't handle that level, those kind of standards. But if you create those kind of standards, you will attract. I just had a client recently, they did amazing work on this stuff on values, and they're hiring sort of a second tier management. 2 people applied for them are people who had their own practices. And the reason they applied for the job was when the recruiter reached out to them, they shared the values and they said, I want to be part of that. People were willing to close their own businesses to come and join this place because of the culture they were creating. Super cool. Then you got to think about what the incentives are. Like I say, if you pay project managers based on productivity and you don't have any incentives around safety, you've got to break in terms of what people are motivated to do and what you're saying they should do. You then got to look at your systems, you know, on that safety front. I had a client that was doing, they're a construction company. The only weekly reports they had to put in were productivity targets. They had no documents that tracked safety incidents or lack of safety incidents, or people doing good things to catch safety issues. And so there was no system that supported the value of safety. So you've got to look at your organization and say, and sometimes you're not going to see it. You got to bring your people into that conversation and say, which of our systems are supporting or working against the values that we say we want to live? And then finally, this is more subtle, but this is the signals. And you as the leaders really have to own this one. What are you signaling is important? You know, if somebody who's a jerk gets the parking spot up front because they brought in the bigger client, you're really saying your values are fine until they bump up against money, right? And I'll tell you just one, and this will be the last story. But I had a client, they had a salesperson brought in about 6 million a year in their revenue, was a cultural disaster after they did all the cultural work. Like would just go into the production department, would get everybody upset, didn't behave with any of the values. And the organization was really in this quandary. Like, what do we do? That's $6 million in revenue. I made this suggestion to them that they didn't want to do it first. And then 6 months later, they wound up doing it. They actually hired somebody to be an executive assistant to this $6 million salesperson. And that salesperson was not allowed to interface with the production department anymore. It had to all go through her executive assistant. And what was fast, it was a $50,000 investment. What it did culturally to that organization was astonishing, because everyone understood, right? Nobody's stupid. We don't want $6 million to leave, because that means other people's jobs are going to leave. But by doing that $50,000 investment in an executive assistant, it said to everybody that we take this seriously and we're going to protect you from anything that would damage the culture. And people then went, you're actually serious about this now. And that's when that's for them when the culture really kind of took off. So when you do this work, these are the steps to get there: values, behaviors, incentives, systems, signals. And then talking about it all the time. Eventually you can move it into performance management, but don't lead with that. All right. But if you do that and you have a high performance culture, you will enjoy your business more, and it'll be a highly more saleable business. That's it.
Sweet, thanks, Warren. That 3-hour exercise sounds like you just revolutionized strategic planning when it comes to purpose, vision, mission. That's kind of really cool. I know a lot of people hate being dragged through the mud on that kind of stuff, so that's awesome.
It's fun too. It's actually done with a bunch of exercises that people leave having had a blast.
That's cool. Any questions quickly before we move on and get into the breakout rooms?
We still have a few more presentations. Yeah, we got Mike Henley.
Yeah, I know. I got Mike and Alex. I'm just saying in terms of before, we're going to go into breakout rooms later on to ask specific stuff around this. So it's just if there's any like broad stroke questions anybody wanted to get to. Yeah, I'm under the impression Petit Papa is up next. Mr. Michael Henley.
Yes.
The official MFer.
Thank you.
All right, we're good. So we'll let you take it away, Mike.
All right. So I do not have a PowerPoint presentation. This is going to be just a brief taste on estate planning. So thank you for everyone who's joined here. I am Mike Henley. I'm a partner with Miller Thompson. We're a national law firm with 12 offices across Canada. We have 3 in SWO. So we have Guelph, Kitchener-Waterloo, and London. So I practice out of the Guelph office, and I practice happy law. So I practice corporate real estate and estate planning. So we do have litigators, but we just put them away for a while until you need them. Hopefully you never need them. So today I'm going to talk about estate planning, and my purpose here is to scare you all. During COVID, I saw a big increase in people wanting to get this process in place to get their wills done and powers of attorney. The stats are 50% of adult Canadians do not have a will or powers of attorney. So of course the will deals with your assets, and then you appoint an executor who takes care of your estate. So one thing to take away from this is be very careful who you appoint as your executor, because it is a complex job. It can be time consuming if you don't do your will right, or if there's problems with beneficiaries or problems with tax, anything like that, you know, you got to have time, you got to have some kind of financial aptitude and be organized. A lot of people now are choosing to have an executor not be a family member, but they're choosing a trust company. So big banks all have trust companies that you can utilize for that. You really want to make it easy for who you leave behind. So you want to be organized, you want to have your stuff together. So for entrepreneurs, for businesses, in Ontario, you're allowed to have more than one will. So most of my business clients have a primary will and a secondary will. So typically a primary will deals with assets that will require probate, and I'll get into that in a second, what probate is. And when you probate, you pay an estate administration tax. So I'll get into that. So a primary will deal with the assets that will require probate and applies to assets that fall under this will. So things such as real estate, non-registered investments, bank accounts will require probate. And normally assets such as private company shares, closely held partnerships, assets held in trust for the benefit of an individual, personal articles, and loans to private companies and family members do not require probate. So this is a very popular planning option that I do with owners of closely held businesses. So, so the two main advantages of the secondary will, of having this secondary will, is number one, it keeps your private information private. And number two, it saves on estate administration tax. So estate administration tax is roughly it is 1.5% on the value of the assets over $50,000. So you have a company worth a couple $1 million, you could be paying, you know, $30,000 in estate tax. When I say keep your private information private, so when you probate a will, so probate is the big name for probate is certificate of appointment of estate trustee with a will. It's an application to the court and it's proof. So the court approves this, and then it's proof that the executor has authority to deal with the estate. So when you probate the will, it's a court application, it's a public document. So anyone can go into court and have a look at this, and it'll list the value of your assets. So if you have everything in the primary will, such as shares of a private company, those you have to declare the value of that to the court. So if you have it in a secondary will does not require probate. You're not providing this information to the public. Okay. So once you receive probate, your executor goes out and carries out the wishes of your will, and it'll carry out the wishes of the primary will, who gets what, and the secondary will. So just a couple of interesting points on wills. I mean, I could go all day on this because there's a lot of nuances and a lot of, you know, goofy stuff that happens. But so here's a pop quiz. So say you're 25 years old and you thought, man, I'm young and I just bought a house and I'm gonna do my will. So he gets his will done. And then a couple of years later, he gets married. Is the will valid? No, the will is not valid. Marriage invalidates a will unless it's made in contemplation of marriage. So if you're engaged and you want to do your wills before marriage, as long as the will is made in contemplation of marriage, which I have specific language that I put in the wills, then it'll be valid. Does divorce invalidate a will? No, the will is still valid. However, the spouse named in the will, it's as if that spouse is removed from the will. So it'll read as if a spouse is not in the will. And also what happens often is, you know, elderly couple, you know, the one spouse dies and the other one's still alive. And in order to avoid probate, they put the house or any other assets in joint names with one of the kids. Very bad idea. So you don't want to do that because number one, you know, that child could, you know, divorce or death, if that child dies before or goes bankrupt, that asset could get dragged into that. And plus, if it's a principal residence of the parent, you could lose your capital gains or your principal residence exemption. So the presumption is that property held jointly by an adult child is held in the resulting trust, and the value of the property is subject to estate administration tax. So you just want to be careful when you're planning things. Highly recommend you speak with an accountant who's qualified in giving advice on this, because when you have, there's could be serious tax consequences on how you do your estate planning. So when I do my estate planning, it's not just, hey, I'm going to do your will and powers of attorney. No, we're going to talk about your estate plan and what you have and what, and how we're going to organize this to, minimize tax payable on death. So that's basically what I have. I know, we're a bit over time here, so I'm happy to answer any questions afterwards.
Awesome, thanks, Mike. Does anybody have any immediate questions?
Mike, would you be able to, it's Brian Hansel here, would you be able to share a list of those things that you indicated that should go in the primary will and the things that belong in the secondary will? It was a great list. I just couldn't type fast enough.
Oh, okay. Yeah. I mean, it's very general.
No, absolutely.
Yeah.
But it's pointing a better direction than I have right now.
Yeah. So, yeah, I can provide you with that list.
Great. Thank you.
Awesome. All right, so we have Alex up next. I don't know if anybody wants a break. If you do, give me a thumbs up. We can do 5 minutes, or we can keep rolling and get Alex on, then we can go into the breakout rooms. Everybody looks good? All right, Alex, do you want to kick us off?
Awesome, yep. Let me just get this rock rolling. All right, everyone sees the same page.
Yeah.
So today what I wanted to talk to you guys about is what you need to know about the government subsidy programs. So we all know what happened last March when the pandemic hit, and the government had to do something. And so various programs, right or wrong, were released. And to give you a little bit of background, the policy changes that were made with respect to these government subsidy programs, they would typically take anywhere from 6 to 18 months to administer, draft the legislation, get it approved and rolled out throughout the country or throughout the province. A lot of these programs were released within 6 to 8 days. And so what happened, and what you will see, is with the blink of an eye or snap of the fingers, a lot of these programs have changed and will continue to change. And I'll talk about a bit of that today. So there is tons and tons and tons of government subsidy programs out there. But what I want to talk about today is kind of 3 key programs and kind of an overall overview of where we're at with respect to at a federal level, the Ontario level, and the 3 biggest programs that we see at RLB with respect to our clients and what is the most important to business owners of your life. So at a federal level, the Liberal government released Canada's COVID-19 economic response plan, and they have a great website that outlines absolutely everything for individuals, businesses, different sectors, support for such things like domestic violence or how to care for elders. So their full economic response plan is outlined on their website. And the key thing there with respect to businesses is some of the programs that we're going to talk about today. Now, this website is initially was getting updated by the day, by the hour, and now it's more or less by the month. So what I always advise a lot of clients and what we talk to them about is continuing to monitor the website for updates and program applications for those programs that have yet to start. Now, how those changes were made was feedback internally, as well as feedback from business owners through their local MP. So here in Guelph, a lot of the business owners that reviewed some of these government subsidy programs, that if it didn't fit exactly the situation they are in as a result of the pandemic, they wrote letters, had conversations, emails with Lloyd Longfield, and that's the best way to get your thoughts, your suggestions with regards to changes back to the federal level. Now, from an Ontario perspective, Doug Ford and his team released what's called COVID-19 Help for Businesses in Ontario. So because a lot of the programs are administered at a federal level, what Doug Ford and the Ontario government did was on more of a granular level with much smaller programs that they had more control over. So the one that has recently come out is the Ontario Small Business Support Grant, which can offer up to $20,000. So there's criteria outlined with respect to how businesses can qualify for that. The one overarching comment I should make is that a lot of these programs are very fact driven. And so if you have any questions as to whether or not you qualify, please look at either websites, reach out to your accountant, and can have a conversation as to whether or not it may apply. Outside of that, Doug Ford had a lot of control with respect to rebates and programs he put in place for PPE, property taxes, and energy bills. The one that we've all seen rather personally in our own houses or throughout our business is changing our electricity rates, as what he rolled out to be the affordability electricity bills. Now, there's a lot of money going out from both the federal and provincial governments. And so there's a lot of speculation in the marketplace right now that there's going to be potential future tax increases, either at the personal level or at the corporate level, with the understanding that someone's got to pay for all these subsidies. So I could talk all day about potential changes, but that'll be an aside for later if you guys want to talk further about that. So the biggest program that we see with respect to our clients and getting the greatest benefit for themselves is the Canada Emergency Wage Subsidy. And so this requires them for there's 13 periods in total, allows for them to get funding through the federal government for continuing to pay employees during the pandemic. Now, the wage subsidy is taxable. It does offset the wages that you do pay, and you get a deduction for the net amount. Early on, there was the temporary emergency wage subsidy that didn't have any revenue drop criteria with respect to it. So if you receive the Qs or what they call the TEWs, both of those are taxable as a business owner. The biggest thing that a lot of our clients are right into right now is the T4 reporting that is required. Effectively, what the government has done is they've required for 2020 you to break out the revenue by periods that align with the Qs. So that way they can review your Qs claims and they can go over some of your employees that may have claimed the CERB. So we strongly encourage that you review the reporting requirements if you do your own T4 reporting. If not, reach out to your accountant for assistance because all of this is going to alleviate CRA review upon filing your T4s by the end of the month. And the last thing you want is to have to deal with CRA this summer or next fall with respect to your T4 reporting, and with that, if there is any misreporting, it could have an impact on your employees when they file their personal tax returns. So the last day, the one thing I also want to know is the last day to apply for period 6, which is basically the month of August, is Thursday, February 25th. There's a lot of money on the line, for business owners. A lot of business owners say, you know what, I'm too busy dealing with this pandemic, too busy. I can't pull together the numbers, my controller's at home trying to become a teacher, we should just strongly encourage that you do take the time to apply for the wage subsidy, if it does apply to you, as there is a lot of government funding that can be available that can take some of that strain off your business. We've had business owners easily get 10, 20, 30, 40,000 by just taking the time and applying for the applicable periods. So right now it's extended to the end of March, the end of the 13th period, and we'll see whether or not they continue on with that. The second one, which is the most popular, and I would say the easiest or the low-hanging fruit, is the Canada Emergency Bank Account. It initially was a $40,000 interest-free loan program that's been expanded in December to allow for an interest-free loan up to $60,000. Up to $20,000 of that may be forgiven if the loan balance is repaid by the end of 2022. So it's a simple application through your bank or credit union. The applications are open until the end of March 2021. The key thing, and there's parameters with respect to these interest-free loans, with respect to using the funds for your ongoing operations. So as a business owner, you can't take the $60,000 and increase the amount of your dividend or salary that you pay yourself this year. There are some limitations to that, so you need to use it in your business, but it can be through the payment of salaries. So the two applicable streams for businesses are the payroll stream, where a business has between $20,000 and $1.5 million of employment income paid for calendar 2019. Or if they don't meet that threshold, if they're less than $20,000 of employment income, they can go under what's called the non-deferrable expense stream. So that deals with property tax, insurance, any other operating costs that may apply to your business. And the majority of the businesses that apply for that or go through that stream are those that either paid themselves or paid those involved in the business through dividends, or just got started off and off the ground before the pandemic hit. So the forgivable portion as well is taxable when received. So if you receive all 60,000 today, then the 20,000 that may be forgivable is actually included in income in your current fiscal year. And if you do have to pay back that forgivable portion in the future, you will receive a deduction at that time. So although the forgiveness may not come until the end of 2022, a lot of our clients and a lot of those that receive these loans will pay tax in either 2020 or 2021. The one program that was released that never really took off was the Canada Emergency Commercial Rent Assistance Program. That required participation from a lot of landlords. If they participated in the program and forgave a portion of the rent, then there could have been a break for the tenant. 80% of landlords in Canada did not partake, and it was an absolute bust. So they revised the program, and it's now renamed the Canada Emergency Rent Subsidy. So this covers from the end of September 2020 all the way to June 2021. So there's no longer any participation required by landlords. The subsidy does provide payments to qualified renters, or for a lot of business owners that own their own properties, they're potentially eligible for some subsidy amounts. So there are limitations if you do own your own property. The one instance that we see a lot of is a lot of business owners have a holding company or a realco that owns the property that is rented to their operating company. And so there's limitations there on what expenses you can claim. More or less, you're limited to your property taxes, insurance, etc., versus the rent amount that is charged across. So just a couple of things to watch out there. But this really has taken off with a lot of business owners because the limitations before with respect to landlords being required to participate in the program, now with them being put to the side, the government has seen a lot more traction with this. So the subsidy rate is calculated based on your revenue drop for particular periods. They look at it on a month-by-month basis. So for example, they'll compare October 2020 to October 2019, or you have the option to choose the earlier part of 2020. Once again, any subsidies that are received are taxable when received. Unfortunately, there is taxes to pay for a lot of active business owners. The tax rate, the corporate tax rate, is fairly nominal compared to what you're going to receive compared to the overall cost if you didn't receive the subsidy amount in your business. So that's it for me. I'm open the floor to any questions right now. I know there's a lot behind a lot of these programs. The last thing I would like to say is that if you're part of an association, or if you have any connections with any ministries within Ontario, Doug Ford and his team have funneled a lot of COVID funding through a lot of the ministries, and a lot of the associations for a lot of small business owners have a lot of information on some of the forgivable loan programs, grants, or other subsidy programs that may be applicable to those business owners.
Awesome. Thank you, Alex. That was great. So yeah, we have a room for the breakout rooms now. So if just message in the chat which one you want to go into, and then I will make sure that you guys are in there, and whoever doesn't answer, I'll just throw you into a room. Okay, I've got a couple people messaging me.
Hey, Trish?
Yeah.
Is it the one with Warren, Zach, Alex, Mike, and then I'm just trying to figure out, or is it an individual breakout room? Sorry.
They're all individual breakout rooms with each of the SAPs.
Perfect.
Yeah.
I wasn't sure if it was 3 in one or 3 in the other. Okay, thank you.
No, it's a good question. Yeah. So you can either tell me now, or you can just pop it in the chat. Might be a bit easier in the chat so I can manage it.
While you're doing that, Trisha, Alex, I was kind of cutting in and out, so I'm not sure if you addressed this, but is there one program that you...
Oh, Rob, you totally just cut out.
I didn't hear Rob.
I had a question for Alex, which is on the rent one.
Yeah.
If you're a multi-location business, like say you're a retailer with 3 or 4 outlets,
yeah,
and one location is like really hurting, and a couple of the others aren't, can you do it by location, or is it just organization wide?
Yeah, so they have what's called the affiliated rules. So they look at if they're in different corporations, they look at that, and then they look at the overall revenue drop. So I believe it's got to be in separate corporations in order to do so. But that's how they're trying to look at it as a collective group of potentially related companies.
I had a question for Alex too. So the rent subsidy, is that similar to the wage subsidy, where you said it's looked at monthly, and to maximize wage subsidy, I think it was 50%, or it's changing all the time. Is that similar in the rent? Is there kind of a threshold of income loss?
Yeah. So what it looks like is it compares month to month. So although year over year you may have been increased in revenue, what it looks at is for those particular months, what's your revenue drop, and based on the percentage amount of your revenue drop, it will put you into a specific category as to whether or not your subsidy amount's 10, 20, 30%.
So maximum's 30% of rent, is that what you're...
They keep tweaking. It's either 30 or 50% of rent. But yeah, it looks at it on a monthly basis. So the other thing with the rent subsidy is there's eligible expenses. So rent's the most common one, but if you own your own building, then such things as property tax, insurance, et cetera, with regards to the operation of your own building may qualify.
Cool. All right. It looks like a few people are jetting, so I think it'll just be easier if anybody has any questions specifically for the SAPs, just either throw them in the chat, come off mute, or you can connect directly with them after. But I think it'll just be more worthwhile if we do it in a group, just because it is a little bit smaller.
Ask us something hard.
Ask Warren something hard. I'm good.
John, you had a question?
Yeah, I was gonna ask Alex.
Who's gonna win the Super Bowl?
Go ahead,
I'll
John.
take that one first. I haven't bet against my kid yet. No, I was going to say, so one of the comments you made is that my assumption is us as business owners across the area, not mattering what kind of we do, are essentially going to have to subsidize this great country, probably starting the 2022 budget season to cover all the shortfalls. So I sort of see it as a short runway to get to do possibly certain things that may or may not be grandfathered as a business owner. Any thoughts on that to protect assets from tax, to crystallize gains either for an individual or business owner going forward?
Yeah, for sure. So the question becomes is when and not if, with respect to a lot of the speculation. Now, the one thing that there's a lot of speculation in the marketplace currently is the change of the capital gains inclusion rate. So moving it from a 50% inclusion rate all the way either to 2/3 or 75%. Now, that's an easy way for them to get additional tax revenue. Typically, when they make a policy change within their budget, they either do one of three things. They either go retro to January 1 as a budget date, or they select a future date. Anytime that they've changed the capital gains inclusion rate, it's always been budget date. They don't want to give business owners, they don't want to give practitioners any more time to do any sort of planning. We had some speculation in 2016 and 17 as to whether or not the Liberals were going to change the inclusion rate. And we did a lot of capital gains tax planning for clients back then, with the understanding is that we're not in the war room. We have no idea what's going to be in the budget. However, it may come, here's the prepayment of tax cost, but also here could be the additional tax cost to you if they do implement it. So we're having similar conversations now. We've done a lot of capital gains tax planning. For a lot of business owners, what that involves is, either triggering gains internally through share transactions, or selling assets or shares between corporations that you may own, and effectively locking in that 50% capital gains inclusion rate. There's currently a gap between capital gains rates and dividend rates in Canada. So it's more preferential for business owners to pay tax at capital gains rates. The tough thing is writing that check to the government and prepaying that corporate tax or personal tax can be hard, but looking at a macro level, the overall tax savings can be very beneficial. The other thing that they're potentially looking at, which the NDP have proposed, is a wealth tax. So we're not sure. There's not as much speculation with respect to the wealth tax, but that is certainly on the table as to what they may do for those business owners, individuals that have either an income test or an asset test over a threshold. We've heard a little bit of both. So there is some speculation. I think they're going to do it within the next 3 years. Can't guarantee when. There is an election this spring. A lot of people have the thought that, you know, who this may apply to, they may not already get the votes from those individuals. And so there isn't a whole lot of concern from a policy and political perspective for the Liberal Party. But they have to generate some tax revenue at some point. And so there's a lot of speculation that it's either going to be in budget 2021 or 2022. Does that help, John?
In general, yeah, that's great. I guess as we get things more concrete.
Yeah. So what I would say is that if you're, the biggest thing that we're doing planning for is capital gains tax planning. So if you want to protect yourself, protect your assets and your overall net worth, then what I would say is talk to your tax advisor about some potential restructuring transactions that you can execute in order to take advantage of that.
Okay, thanks, Alex.
Welcome.
I think Brian has a question for Warren. Brian, if you want to hop off mute.
Yeah, Warren, your topic spoke to me. In particular, you mentioned the one example where the organization had a $6 million salesperson who was abusing, you know, some of the team around them, and the solution was to bring in an assistant to sort of create that barrier. I have a similar situation with a high performer here, but I'm just wondering if that doesn't set an example that bad behavior is okay, or excusing it by just putting up a barrier. What's the calculus behind sort of navigating that and having, you know, not having the other employees think, well, this person's getting away with it, they just put in, you know, a workaround for her.
Yeah, I mean, it's a great question. There's a lot more facts behind that story. A lot of it depends on, like when you say what goes into the calculation. So in that calculation, in their industry, it's super hard to find salespeople at that caliber. B, the consequence of losing that person meant a bunch of those clients would likely walk. There were some things that were done after the fact to make sure that salespeople couldn't walk with clients, to make sure that the client relationships are more entrenched with the organization rather than the salesperson. And as a result of where they were, that people would have walked, that would have probably lost a lot of jobs. So they're a pretty open organization. So people actually understood what the consequences would be. And so even the people who were on the negative end of that person's behavior didn't really want to lose all that business because they would lose jobs as well. So they actually understood through the communications that this was a compromise solution. I have been in other organizations where people have said, you know what, that money is easily replaceable. It'll be bumpy for 6 months or something, but we got to get rid of that person. Right. Because just that corrosive influence of one individual in the organization is just too destructive to warrant, you know, keeping them there. It was something unique about the structure of their organization that allowed that sort of walling her off to be very effective. It's not necessarily the solution that'll work in every organization. You know, one of the things that as I say, depending on what your time frame is, if you can wind up having the relationship built between you and the rest of the team and the client, so that salesperson isn't so cocky as to think when they walk, the client's going to walk with them, that in itself can constrain some of that behavior. And you know, in addition to that, even before all of that, you know, have there been conversations with that person about their behavior, and is it values aligned? Like if you haven't done the cultural work and got people bought into the culture, then it's hard to hold somebody to it as well, right? So there's sort of a cascading. First you do culture, then you do sort of compliance conversations, then you say either the person goes or we have to scaffold around them.
That's great.
Does that make sense?
Yeah, it does. No, it gives some nice context around that. Thank you.
Yeah, I mean, there are lots of people will just say, screw it, get rid of the person, and we'll make up the money later because they're just too destructive. I owned a business where that happened. I had a quick story. I had a guy, we gave him his first vice presidency, his first corner office. I'd seen him through postpartum depression of his wife after their firstborn, the anniversary of his best friend's suicide, all this kind of stuff. We hired a new guy, a senior guy in the organization. Within 3 weeks, this VP came in my office and looked at me and said, you guys are trying to screw us by blah, blah. And I went, what in the 5 years that you've known me would ever lead you to believe that I would be motivated to do something like that? And he looked at me sort of stunned and he went, well, he said. And that's all it took, right? One poisonous person in a position of influence to start undermining the culture. And if you value culture, you got to really prevent that from happening.
That's great. Thank you.
Does anybody else have any questions? I'll email out all the SAPs emails after as well, so that you guys can connect with them one-on-one if you have any further questions or want to connect with them individually. Ooh. Okay, awesome. Well, thank you so much, everyone. That was super valuable. It was a lot of information. I have recorded it, so I will be sending it out to the rest of the chapter as well. But I got a lot of private messages to everybody just saying that they got a lot out of this session. And obviously, we're very grateful to have such amazing partners. We always like to see you guys are more like members than partners. So we're really grateful to have you and the wealth of knowledge that you bring. So thank you, everyone. And I will send out an email shortly.
Thanks, everybody.
Awesome. Thanks,
Bye.
Thanks,
Thank you.
Thanks, guys.
Thanks.